Okay, do we have any new member? Dorcas, I guess you are new. Dorcas, are you new?
Yes, I
I
am.
can't hear you. I can't hear you.
Yes, I'm new. I'm new.
Okay, please introduce yourself. Just your name and your location.
Okay, my name is Dorcas. I'm based in Lagos.
Okay, Lagos. Okay, nice to meet you, Dorcas. You're welcome to Next Gen Professional Associates. Right. So you're lucky we just want to start a new topic. You're welcome, Dorcas.
Okay.
Okay, let's quickly start today's class properly, right? So in today's class, welcome again to Next Gen Professional Associates. In today's class, we shall be looking at capital budgeting, which is investment appraiser class. In our introduction to strategic financial management, if you can recall, I said that one of the functions of the financial manager, right, is to make an investment decision. Now, when you want to make an investment decision, you need to look at, oh, will this project viable or not? And that is what brings capital budget of investment appraiser, because you want to use it for what? Decision making class. Don't forget at the beginning, we mentioned that one of the functions of a financial manager is to make an investment decision, right? So when you make an investment decision, before you can consider the sources of finance, is that also before you can say, oh, when you consider the sources of finance, you look at the dividend policy as well. As part of the what you analyze the risk of the business, right? Now, as a financial manager, you want to make an investment decision, and this will take us to investment appraiser, which is mainly for what? For investment what? To make what? Investment decision class. Now, let's start with this. Capital budget is mainly for when you want to go into a long-term investment in terms of capital, right? Probably you want to make an investment decision. Probably you want to go into expansion of your business, acquisition, modernization, or replacement, right? You want to replace some of these assets, and you could say you could make and what? You could make what? Capital budget what? Decision. That is what bring our capital budgeting, because you want to use it for what? Investment decision. Either you want to expand your business, or you want to acquire modernization, you want to make it look nice, right? Or you want to replace some of these assets. Now, in this case, this will take us to the investment decision that we have. Oh, excuse me. Investment decision that we have. The decision involve a large initial outlay. Of course, class, when you want to start a project, when you want to start an investment, there will be a cost of that what? Particular investment, and this is known as what? Initial outlay. Now, it is a risky what? Decision. Of course, there must be a risk in what you are doing, right? Your finance managers, your CFO, others, we analyze the risk of the business, and these are the characteristics or features of what? Investment decision. Now, what is capital budget and the importance of capital investment decision class? A capital budget is a program of capital expenditure for the next few years, updated every year, right? Now, what it means is that you it is mainly for capital projects. When you talk about capital budget or investment appraiser, it is mainly for what? You want to undertake a project, then you look at it, oh, will this project be viable or not? Right? Now, we'll get to where, if it is positive, what is the decision? If it is negative, what is the decision? Now, we quickly move to the importance of capital investment decision in an organization. Now, this note will be sent to you so that you can read up this part, so that we can quickly move ahead of our time. This is not where we want to start from, right? This is just story. We already know most of all these things, right? Now, there is stages of the capital budgeting process. You can read that up, right? When I send the notes, you can read that up, right? The stages of what capital budget in every organization. Now, let's quickly, this is where we are now. Classification of capital investment decision. Now, when you want to make a capital investment decision, you can classify it in different formats. You can classify it in what? In different ways, right? Number one, expansion of existing business. Class. What is capital investment? You want to embark on a project, or you want to embark on a project and you want to expand, or you want to expand your business, right? You could say this is a capital, you want to make a capital investment decision, right? Because it involves what? Capital investment, right? So expansion of expansion of existing business, right? You have an existing business that you want to expand it, and you are looking at it. Oh, if I expand this business, what will be the cash flow? Will it bring any inflow or additional value to me? Is that also expansion of new business? Now you can decide that, oh, you want to go into another new business entirely. All right, you don't want the existing. Don't forget that under the risk adjusted cost of capital, you will see where company is diversifying. Company that is producing rice want to go into production of cement, right? So with that, you are making a capital investment decision. Now, replacement and modernization to reduce cost and improve what? Efficiency. Now, you can decide that, oh, you want to replace some of your assets. It is part of capital investment decision. It is a decision you are making, right? You want to what? Replace what? Some of your assets in order to what? To reduce what? Cost, right? Capital investment for maintenance of market position, capital maintenance, capital investment for new product and diversification. Class. Now, you will see most of questions that we will solve, right? Under the investment appraiser will be Ican tough question for the past few years, and as well as ACCA questions, whereby you will have two products and the company want to diversify. Class, don't forget that when you see in a question that a company want to diversify into the production of company, Dorcas is into production of rice, and Dorcas now want to diversify into the production of cement. Now, once you make you just read that paragraph, you should know that, oh, they will consider the risk of that industry that Dorcas is diversifying into, which will take us to appropriate cost of capital, right? Which means that when you want to discount that project, you use appropriate cost of capital, because there is an indication of what? Diversification. We'll get there. Now, another thing we need to talk about under the capital, when you want to make a capital investment decision, is capital investment for safety and what? Environmental consideration, right? You could use that to what? In the process of doing that, you are making a what? A capital investment decision. Now, another part we should pay attention to, although when we get to capital rationing, we will talk more on that, but we need to mention it, is mutually exclusive investment. Class, pay attention to this. It will help you when we get to capital what? Rationing, right? Now, mutually exclusive investment. It is part of capital investment decision you are making. Now, when they say a project is mutually exclusive, right? Mutually exclusive means that when you undertake one, you don't need to undertake the second one. You can actually reject it, right? Now, that is why I said, oh, mutually exclusive investment are projects which are serve the same purpose and compete with one another. To choose one entails what? Rejecting the other. Which means that when you see it in a question that they say, oh, this project is mutually exclusive. Reason that they have common purpose, right? So you can, so when you want to choose any of these two, that is when you will now do your profitability index and all that, but we will get there. But have the understanding that a mutually exclusive investment, a mutually exclusive investment means that the same project, a project that serve the same purpose, right? Which means that when you undertake one, you will reject the other one. Now, another thing is that when you want to make capital investment decision is what we call independent investment. Now, in the independent investment are projects which serve different purpose and do not compete with one another. You can see when you see it in a question, because we will examine some question as we move on, right? Independent investment. Independent investments are projects that you can undertake without depending on anyone. You can actually undertake this project without, but when you want to undertake all these projects, it depends on your capital, what you have. You cannot have 50 naira now and you want to undertake. Dorcas cannot have 15 naira now, and Dorcas want to undertake like 50 projects. It is not possible. Is that possible? It's not possible. Is that not so? So that is what I mean by what independent what investment. Now, another thing is contingent. All these are capital investment decision. When you want to make, it's part of capital investment decision, right? Contingent slash dependent investment are projects performed together, and so the undertaking of one entails undertaking. So these are contingent, right? They depend on each other. When you undertake that particular, when you want to go, you want to build, let's say you want to build an hospital, you will need labor. Now, unless if you don't want to build the hospital, that is when you will not bring in labor. Those people who will work in the world, who will work in that particular work project, just like what they are doing in our side now, Kubwa Express in Abuja now. So you can see that they bring in labor people that they should come and do what? Work, right? That is a dependent what investment, right? And that is part of what capital what investment. Class, are we still together? I need to confirm before we move ahead. Class, are we still together?
Yes, sir.
Yes,
Okay,
sir.
Yes, sir.
okay. Thank you so much. So I'm just explaining the capital investment decision. Most likely, where an investment or capital project that has to do with investment decision. So that is why I said we need to understand all these things. So as we move on now, there is what we call divisible investment approach. There are when you want to make a capital investment decision, there is what we call divisible investment. Please know all these terms because when we get to that capital rationing, we move on. That is how we roll, right? Now, divisible investment means that our investments which can be partly what performed or executed in fraction. See, divisible investments are investment that can be undertaken partially. For instance, now, class, you want to undertake project A, project B. You have 50 naira, and project A will cost you 40 naira. Project B will cost you 20 naira, and you have 50 naira. You can see that you cannot undertake the two. You can decide that, oh, the feasible project, okay, let me take one. I will now take fraction of B, so that I will move on. That is what we call divisible what investment, right? That is what we call what partially, right? When we get to capital rationing, you will understand what I'm talking about. Now, investment in indivisible investment projects that you cannot execute them partially, right? Because they are multiple, they are important. You cannot say, oh, because of this. No, 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 no. It's not that. You must execute it. Even if you need to go and borrow, you don't have enough money, you need to go and borrow to finance that particular what investment, right? And these are all what we call capital investment decision. When they are talking about capital investment, you say, oh, there are different form of capital investment decision. Is it expansion? Is it diversification? Is it capital? Is it mutually exclusive? Is it this? Is it that? And this is what they are talking about. When you hear people talking about capital investment decision. Now, let's quickly move ahead. So, let's quickly move ahead to the factors information required for effective capital budget. Now, when these are the factors that is most important, when you want to embark on a project, you need to determine the method of investment appraisal. We'll get there. You need to determine what the methods of investment appraisal when we have the payback period and the likes, right? The sources of finance. So the question, don't forget that the sources of finance is part of the function, financing function. Is see under the introduction to strategic financial management, recall that one of the function we have investment decision, right? When you have an investment, you think of the sources of finance, which is the financing function. Is that also when you have the financing function, you finance the business? Is that also you can equally have dividend decision? Is that also before you have dividend, you need to analyze the risk of that what particular investment class. So this you can see where you can see from the function of a financial manager, we have treated the sources of finance, which is the cost of capital. Is that also? Now, another part of it is what capital budget is a capital investment decision. Is that also? Which is what capital budget. You can see we will still get to capital, we will get to what dividend policy as well, right? Now, these are the things you need to consider when you want to take up a capital project. You can see that characteristics of a sound investment evaluation. You will know this. You can when I send this notes and all these things, right? You just show it. Now, another thing is that they say note cash outflow are represented by negative figures, while cash inflow are represented by positive figures. You will know all these things as we move. Now, year zero. Year zero represent the initial year or date of making an investment. Class, your year zero, which is the cost of that particular set, the cost of that particular investment will represent year zero, right? Which will form your outflow, right? Because when you want to finance a project, you need to have enough money. That money, that capital that you have is what we call what is an outflow, right? It will be at your what? At your year zero. So start from year two is same as what year one and so on and so forth. So we'll get to that fact as we move, right? Now, let's quickly move ahead. So investment appraisal techniques. These are the techniques for investment appraisal. When you want to appraise a capital investment, there are two methods. One, the traditional approach and the discounted cash flow techniques. Our focus is on the modern, which is what discounted cash flow. Others will just talk about it and we'll move ahead, right? Now, when you talk about the modern or discounted cash flow techniques, excuse me, or you talk about non-discounted cash flow techniques, are techniques which does not what consider the time value of money, right? They don't understand the time value of money, right? They don't understand that, oh, what will be the present value of 50 naira? You said this 50 naira will be for 5 years. What will be the present value? I want to know the present value of that 5 years now. It doesn't consider the time value of what money, which include what the payback period as well as what accounting rate of return, right? Another part is that the modern or discounted cash flow techniques. Now, when you are talking about the modern or discounted cash flow, these are the discounted cash that recognize what the time value of what money. You talk about the net present value, and you talk about internal rate of return as well as profitability index. We'll get to all those parts, right? Now, we already know payback period. We'll just talk about it. We'll move on, right? Now, what is payback period? Payback period is the period at which you will use to recoup your investment, the time you will pay back, right? It is the time that a project will take to pay back the money spent on it. Is that also? You spend 50 naira on this project. When will I recoup my money? Oh, that is payback period, class. That is what? Payback period. What is the decision rule? The decision rule says that you should choose the shorter period. When you want to embark on 2 projects, and you now see that, oh, the payback period of project A is greater than the payback period of project B. You look at it, Omo, as an investor, as a rational investor, don't forget that you are all an investor, right? When we get to portfolio theory, we will know, you will see how you will make an investment decision, right? This is capital, based on capital investment. Why in portfolio is stocks. We'll get there. Now, you now say, oh, you have to use the shorter period because that will give you quickly recoup your money back before the what? Before a specific what period. And that is that you can see the advantages of it is simple, it is easy, blah blah blah, and as well as not subjective profit. So now another thing is the accounting rate of return, right? Although we have discounted payback period, right, which is not examined in our syllabus, right? I think it's skills and the likes, right? Now, accounting rate of return. Accounting rate of returns make use of accounting profits. It does not make use of what? Cash flow. And it is what? It's subjective because accounting profit itself, it's subjective because you charge different method of depreciation, right? Different method of it's subject, it's based on your own opinion. You can read, I don't want to say this. You can change it to any format you want to use, but it will be in line with what IFRS we know. But it is actually what? Subjective. Now, what is the formula for calculating accounting rate of what? Return. The formula is the average investment, average profit after tax. What is average profit after tax? Means that they give you profit from year 1 to year 2. You add the total profit, divide it by the numbers of years. You have what? Average what? Profit. You move on. Divided by average investment. What is the formula for calculating average investment? Initial investment. Initial investment means your own. Initial investment means cost outlay that you want to use for that business, plus the square value, plus the working capital. I didn't include working capital. Divided by the what? 2. We give you what? Average what? Investment, right? So this is what you need to know, right? And that is the average accounting rate of what? Accounting rate of what? Return. Don't forget, our focus is not this, right? Our focus is the other part, right? Our focus is the other part. Now, let's quickly go to where we are concerned, right? Now, the cash flow, time value of money, investment analysis, sound investment decision should be based on cash flow and not profit, as it's what? The cash that a firm can what? Invest. Class. When you want to embark on an investment decision, it should not be made based on what? Based on accounting profit. It should be based on what? The relevant cash flow. And that cash flow will consider the time value of money, as well as it will also include some uncertainty, which is what? Inflation. Class, which is what? Inflation. We will get to that part, but you need to understand this, right? Now, the concept of time value of money states that the value of money does not remain the same throughout the time. Of course, the value of Naira as at 2013 or 2013 till date 2015 or 2025 is different, right? It cannot remain the same. Since the money available today can earn interest, uncertainty of the cash flow and the inflation which may reduce the purchasing power of money. Of course, inflation can actually reduce the purchasing power of what? Of money. Is that not so? Now, the cash flow to be included in the, so we need to look at, oh, what will be the present value of this if I want to invest in a project for 5 years, class. You want to embark on a project and you say, oh, what will be the present value of that project? Now, with this project viable or not, class, when a project, class, we have started now, please pay attention. Don't forget that there are 2 techniques. 1, the traditional approach. 2, the modern approach. The traditional approach is talking about the payback period, the accounting rate of return. The payback period, the decision is to choose the shorter period, while the accounting rate of return is the average accounting rate of return is talking about what will be the rate of return, and it is just profit, right? It is just what? Profit. Now, why the net present value now? Under the modern method, we are talking about the relevant cash flow, right? And we are talking about the time value of money, which is very what? Which is very what? Important. Class, when you want to embark on a project, class, and that project, a capital investment, you want to make a capital investment decision, and that project give you a positive NPV. The positive NPV indicates that the project is viable, right? Now, when this project is viable, what does this indicate to investor? Now, it indicates that you are maximizing what? Shareholders' wealth, right? Distinguished professional colleagues, don't forget, at the beginning of introduction to strategic financial management, I mentioned that when you want to maximize shareholders' wealth, is to do what? You have to embark on a project that has a what? Positive NPV. So once a project have a positive NPV, it does not mean that, oh, just accept. What is the implication? You need to understand what it means to investor. It means that you are maximizing what? Shareholders what? Shareholders what? Wealth, right? We will get there. Now, if all that is established, right, you need to consider the relevant cash flow, right? Now, characteristics of relevant cash flows, class. When you want to embark on a capital investment project, the cash flow, the relevant costs, which is the outflow or the cash flow that you need to consider, should be relevant to the project. And this will take us to relevant costing in what? In performance management, right? Now, characteristics of relevant cash flows. It should be a future cash flow, and so all sunk, committed, or historical costs are not what? Are not relevant. Do you know why? It should be a future because we want to know the present value of that what? Of that investment. We don't want to know the past. Nobody is going back. We don't want to go back to 2024. Sunk. What is sunk cost? Sunk costs are previous costs. What is committed? Committed, class. Committed. The salary they paid us, because they also pay me salary. The salary they paid us, it is called committed cost. It is salary, right? You see, whether you work or you do not work, you know at the end of the day you will collect salary. You no go do am as well. There are some organization, if you no work, no money. Right? Samson, Samson, are you still there? Exclusive, exclusive. Oh, they are not okay. Okay, please
Around.
unmute your okay, okay. Unmute your mic, Samson. So please, so do you work in a place where whether you work or you do not work, they will give you your money? They will pay you salary.
They play for where?
Abina, but there are some
no
what we
work,
call
no
committed
work, no
costs.
pay.
No work, no pay. That's good. Committed cost. What we call committed costs, you guys. Organization we already budgeted that, oh, we will pay salary of so amount at the end of the period. That is what committed. And historical costs are not relevant costs. You want to embark on a project, a new project, right? Anything that has to do with historical, you don't need it, right? We'll get to all those parts. It should involve actual movement of cash. So depreciation, provision, national cost, apportioned costs are not what? Are not relevant. National costs are for what? Counting profit, right? Those people, those who actually did divisional performance, transfer pricing under what? Under performance management, we understand that, oh, national cost is talking about what? Accounting profit, right? Now, you don't need all those parts. Depreciation, provision, national cost, apportion cost are not what? Are not relevant in what? In when you want to consider relevant cash flow in capital what? Investment. Now, it should be it should be an incremental or differential cash flow, and so fixed cost is not what? Relevant. Now, we'll still talk about fixed cost. Sometimes If the fixed cost is incremental, fixed cost is relevant for the what? For the project, because it's increasing, right? It is not fixed anymore, right? Now, we move on. We move on. Now, opportunity cost. Now, I'm trying to explain the relevant cash flows class. The relevant, you recognize cash flow that are relevant to the project. See, this is where most students make mistakes because they have forgotten their what. They forget their what, their relevant cost, relevant costing, right? Now, opportunity cost is the foregone alternative. Is that also because of the project? And so should be considered as a what? As a relevant cost, which may be what? External. Now, it is what? It is relevant. Opportunity cost. You are looking at it that if you don't want to go into this project class, if you don't want to go into this project, you could go into another project. Now, because you don't want to go into this particular project, it is a cost. Because it is a cost that you will add to that new project you want to go and execute. Because it is a cost. Opportunity cost is a cost there. You need to add it. We'll get there. It is a relevant cost, right? Financing cash flows, such as interest on loan, dividend, preference, dividend are not relevant for investment analysis. They are not what? Investment analysis. It is not that they are not relevant in investment, but anything that has to do with capital investment, they are not what? They are not relevant. Now, they have been considered in determining the cost of capital used for discounting. Of course, the cost of capital, the loan, the dividend, under equity, dividend, the interest under debt, they have already been considered them as what? Under the cost of capital. Right? Now, class, another problem, right? In capital what? In capital investment or in investment decision or investment appraisal is working capital. I'm talking about relevant cash flow, right? Now, working capital are capital you use in running the business on day-to-day activities. You right? Your current assets minus your current liability. Class, you use this money at the beginning of the year. Let me put this. I'm coming. Where is it? Okay. Okay. Now, an increase, class, an increase in working capital reduce cash outflow, and a reduction in working capital improve the cash outflow flow in the year that it happens. Class, when the money you use in running the business is increasing, don't forget that at year zero, the total cost, that money you use in running that business, it will be at year zero, right? It will be at year zero. At the end of the year, of course, when you use money to run business, like now, next gen professional associates, I may decide to say, oh, I want to use 100,000 to run next gen, right? At year zero, it will be at year zero because it will be like a capital. Now, at the end of the diet, I will say, my people, where is my money? 100,000. I will bring it back. Class, if the project is like, let's say, it's for 4 months. Now, at the beginning of month one, I put in 100,000, right? Which is year zero. It will be year zero. It will not count in that month. It will be in year zero. Now, at the end of the diet, I will tell my team, oh, I'm not gonna bring my money, 100,000 naira. At the fourth month, it becomes what? An inflow, right? We will get there because you have to recoup your what? Investment. Class. Now, excuse me. If a project will require an investment in working capital, the investment is treated as a cash outflow at the beginning of the year zero, in which it occurs. And eventually, the last paragraph, I'm reading the last paragraph, and eventually released at the end of the project when it becomes a cash inflow. Class, something. I miss something. Let's do a partner, right?
Ah,
Okay, oh, this project is for 4 months. So something give me 100,000. That 100,000 is like what you will use in running that business. Year zero. At the end, something will tell me that is Oga, it's 4 months already now. Give me my give me back give me my 100,000 first. That is, it becomes what? An inflow. Is that not so? And that is what we call working capital. Class, I purposely use this so that when we see question like this, you'll be able to tackle it, right? And that is how we work, right? That is how it works, right? Now, if that is established, sometimes your working capital will be on a yearly basis. We will get there. Now, why is working capital treated as a cash inflow in the terminal year? What is terminal year, class? Terminal year is the year end of the project. If it is, we run Ican from month 1 to month 4. That month 4 is what we call what? Terminal month. This is because cash flow will exceed cash profit in the year by the amount of reduction in what? In working capital. Class, sometimes your working capital on a yearly basis may actually increase. So we will get there. Don't let me talk about theory. Let's just use one thing as a practical illustration. We'll get there. Now, another relevant cash flow, class. I'm talking about relevant cash flow now. Oh. Please pay attention. It is not that something will tell me that IB, why did you recognize it? Is it relevant cost? Okay, listen. Oh. Now, materials. When material needed for a project is available in the company and has alternative uses, the relevant cost is the replacement cost. Class, let me stop from there first. You have a material, then that material is needed for a particular project. That material is already available in the stock, right? In the company. And you can as well use this material for something else, alternative uses, right? Probably to execute another project. Now, the relevant cost is the replacement. What is the replacement cost? Because why? You need it. Is in the company, but you can as well use it for something else. Is that also? So it becomes an alternative, which means that when you don't get that particular material, it becomes what? A replacement what? A replacement cost. Now, when material is available but has no alternative uses, it's just there. What will you do to that material? The relevant cost is the net. You sell it. See, you dispose it. The material cost is 60. And something now came to meet me that, maybe I want to sell this material. I said, oh, now bring them now. Oh, how much? Okay, 100 naira. 100 naira minus 60 naira, 40 naira. That is net realizable value because it's of no use to something. Is that also? So you sell it. That is what we call net realizable value. But when material is not available, it's not even available at all, class. You quickly go to the market now. You buy it at the what? The current purchased cost. Class. We may see a question like this. So that is why we need to come back to relevant costing. Now, we move ahead. Labor, quickly. Labor, when full-time workers do the job, don't forget that we do full-time. Is that not so? There is a commit. It has already been committed that they will pay us salary at the end of the month, right? It is not relevant because whether you want to go for this project or you don't want to go for this project, you will pay me at the end of the period. But the salary of a casual labor or an overtime is a relevant cost. Class, the salary of a what? Of a casual labor is a what? Is a relevant cost because they are relevant to the what? To the project. They are not they are one-off. When they after the project, everybody fiam. Is that also? Now, variable overhead is always relevant unless stated otherwise. Is that also? Then the fixed cost. is not relevant unless examiner gives the portion that is what? Incremental, right? And that is that about the relevant cash flow. Now, class, the NPV itself, class, the NPV, class, don't forget all these things. I beg. I've mentioned, I've defined capital budget, which is investment appraisal for decision making. I took us back to introduction to what? Strategic financial management. I've mentioned the two techniques for capital investment, right? Which are the modern, the traditional, and the modern. We've talked about the relevant cash flow that are needed in what? In capital investment. Now, now we want to now talk about the NPV itself, right? So this is discounted cash flow technique that recognize the time value of money, right? So when a project is positive, the decision rule is that the company should undertake the project. Why? Should go for the project. Why? Because it will maximize shareholders well. Because don't just tell them that it's possible, they should just no. What does it mean? What is the implication? This is what people want to hear. What will be the impact on the investors, right? So now, class, before you get to net present value, what will you use to discount your project, class? It can be in two ways. It could be the cost of capital or an appropriate cost of capital. Don't forget, when I say appropriate, it means that that company is diversifying. And they will now tell you that use the appropriate cost of capital to discount the project. You should know that definitely there is diversification. Now the question may say, oh, the question may give you 8% this discount cost of capital to discount. Fine, you move on, right? Now, steps in NPV: estimate or identify the relevant cash flows, use the appropriate discount rate or cost of capital, determine the net present value, and interpretation down, 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 down. And that is it, right? I've explained all this decision rule, right? So, internal rate of return, we already know we have examined much of internal rate of return in our previous what lecture, right? You can see the internal rate of return, right? Um, that is it. Okay, what is the decision rule? Decision rule, you look at the return. You know, internal rate of return is based on assumption. Is that not so? The positive NPV, the negative NPV, you get your what? Your internal what? Your internal rate of what? Your internal rate of return. Now, what is the decision rule? Your internal rate of return, the return on investment, is greater than the company cost of capital, the money you use in borrowing. If it is greater, you go for the project, class. Your internal rate of return is higher than the cost for you use the cost of capital, right? The cost that the project will cost you. So you quickly do what? You go for that project, right? So, and let's quickly move ahead. We have the advantages and disadvantages of that. Now, there's what we call modified, excuse me, there's what we call modified internal rate of return, class. Modified internal rate of return, when you are not satisfied, with the internal rate of return, the question could say use modified internal rate of return, and it has what? It has a formula. I forgot to actually include the formula here. Now, modified internal rate of return is an internal rate of return that assumes that project cash flow should be under this method at what? Opportunity cost of what? Capital. So when you are not satisfied with what? Internal rate of return, you could modify it, right? To suit the what? The what? Investment, right? We'll get to that part as well. So the question may say, oh, use the modified internal rate of, calculate the modified internal rate of return. I will include the formula when I'm sending the what? The material out. Now, the profitability index. I won't talk more of profitability index when we get to capital rationing. we'll talk more of divisible projects and mutually exclusive events and all that, right? So, lastly, before we go, now let's talk about inflation and taxation. Let me see, let me quickly check. This part is also very, very important. This part is very important. Please pay attention. Now, pay attention to this part under the capital words. Budget is very important. Taxation and inflation. Inflation is, we know, generally price, increase in the price of goods and what? And services. Is that not so? Now, there are types of inflation here recognized under the capital budget. There is general. General is the one that affects the prices of goods and services in an economy. It could be represented by changing in consumer or related price index. This is uniform inflation on all variables, uniform. So when you see in a question and they tell you that, oh, the inflation rate is 2% on all the items, what it means is that it's a general inflation, right? Is general, is uniform, right? That is what we call what? General what? Inflation. Now, specific inflation are inflation that are specifically for some items, right? Some items that may that may lead to what? Changes in the price. Let's say the sales now may change as a result of what? As a result of inflation. That is specific. You can say that the question may tell you that, oh, inflation rate for sales, first year is 5%, second year is 2%, third year is 4%, this is 5%. Is that not so? They are not, they are not uniform. Labor as well. The first one is this, the second one. So it is specifically for sales. Another one for labor. You can see how specific it is. But if it is general, they will just give you, oh, it is general. They'll just give you one inflation rate for everything. Then you move on. Right? So please pay attention to that part. Inflation. It is usually come out. You will see that they will tell you, oh, selling price increased by 2% in the first year as a result of inflation and thereabout. We will get to that part as well. So, so the existence of more than one inflation rate in a question is an indicator of specific inflation. And the last paragraph, the existence of what? More than, when you have more than one inflation in a question, it becomes what? Specific what? Inflation. Now, types of cash flow, quickly, before we go, types of cash flow. What are the see, it is very important to understand this part, right? Types of cash flow. Okay, Moses,
Good evening, sir. Thank you for this class. Hello,
you're
sir.
welcome. Yeah, I'm with you.
Okay, please, at what point do we use general inflation, sir?
Okay, see, don't even stress yourself. In every question, they will tell you, they will even, the inflation rate is uniform. You don't even like, you don't need it as what self. Just for you to have the knowledge that, oh, this is general. When the inflation rate is uniform, they just give you 2% for everything. Both sales, both your variable cost, both your material is 2%. So you can quickly say, oh, this is what? This is general. But when it is specific, when you have different inflation rates, they give you 2 for sales, they give you 3 for material, they give you 4 for this. Do you understand?
Yes, sir, but my as in, we apply the general.
Don't
That
forget, see, I just want you to have the understanding. Leave the
okay.
application of general and specific. When we get to the bridge, we will know how to cross it, right? So I just want
Okay,
you to
sir.
have the knowledge. Like when you see it, you already know, oh, this is general. There's no formula for it. There's no formula for it. Okay, don't go and say, because I said, it is general, there is formula. I just want you to have understanding that when it is general, it means that it is uniform. You have it. There's no formula. Just have it that, oh, this is general. Oh, when it's specific, you have more than one inflation, you move on. Right? When we get
I
to the bridge, we
understand
know how to
that.
cross it. Do you get?
Thank you very much, sir.
Yeah, you're welcome. Okay, thank you, Moses. Now, type of cash flows, class. Another area you need to pay attention to is the cash flows, right, class? There is money cash flows. Please, some of because okay, let me just hold that. Let me don't mention that part. Money cash flows, right? The money cash flows are actually amount of cash flow used in transaction. That is cash flow in nominal terms. They are inflated cash flows. Now, another name for money cash flow is the nominal cash flow. When they say something is money cash flow, it means that it have the effects of what they are inflated cash flows. It has the element of inflation, right? They are not real. It has what? They are inflated cash flow. It has element of what? Inflation. That is why it is called a money cash flows, right? That is why it is called what? The salary they paid you, right, is a real cash flow, right? Is a real cash flow. Why? Because it does not consider inflation. There is no any inflation effect, right? It does not even change, right? So the real cash flow are the purchasing power equivalent of the actual amount of cash flows. These are cash flows without what? The effect of inflation. It does not even include inflation. Class, let me come again. The money cash flow, oh, 4%. Okay, 4 minutes. Okay. Okay, let me quickly, I'll create before.